My name is Rob Nance. I'm the CEO and co-founder of CityBlock Capital. We're a platform that issues tokenized VC funds. I'll let Anthony and Mark introduce themselves before we get started.
Anthony Pompliano, partner at Morgan Creek Digital Assets.
I'm Mark Yusko, the founder and CEO and CIO of Morgan Creek Capital Management.
Thanks, Mark. Anthony, you ran Full Tilt Capital before joining forces with Mark at Morgan Creek, and you were investing in regular startups through traditional VC fund structure. You wrote a letter that was published widely on the internet where you wrote to your LPs and said, hey, I'm taking a blockchain focus. Can you tell us a little bit about your decision to do that and to move into blockchain assets?
Yeah, I think there's three reasons why we did it. One is, somebody once told me when you're investing, there's two rules: follow the talent and follow the money, right? And so as we were investing in companies, we started to see a lot of talent shift. And so we felt like it was worth investigating more. Money obviously followed that. The second piece was my partner Jason Williams and I had started to build cryptocurrency mining facilities. And one of the aspects there that we really liked was if Bitcoin's price went up or down, Ether went up or down, we still made money every day, right? And so we realized, hey, we're making an infrastructure investment. Everyone else in this world looks at it as a cryptocurrency or a blockchain investment. We looked at it as a real estate investment. So where else can you invest in hard infrastructure assets and make 11% monthly cash on cash returns, right? In the real estate world, that's like you're literally selling snake oil. And so it all was about perspective. And then the third piece was, as we began to look at other areas, we frankly thought that we'd already publicly come out, so we're not going to invest in any ICOs. We think that a lot of them are unregistered securities. We think a lot of them are garbage and they're going to go to zero. And we realized that there was not that many people who had the discipline and patience to take a risk-adjusted approach in the market. And so we felt like there was going to be this big explosion, there was going to be a big crash, and the people who didn't get caught up in the explosion and crash, but kind of steadily just kept a risk-adjusted approach would kind of rise from the ashes, if you will. And so here we are.
And so you met Mark at some point. You ended up joining forces. Mark, can you tell us a little bit about Morgan Creek and what you had been doing at that point and how you met Anthony and your decision to join forces? And
so we spun out of the University of North Carolina. I brought the team out back in 2004. We started as a classic investment advisory firm doing outsourced CIO business. We morphed into doing fund of funds. We morphed from there into doing hybrid investments where we have some of the money outsourced to managers and then we supersize direct portfolios internally. We brought that into doing some direct investment portfolios. And about 5 years ago, a good friend who had started a macro fund that we were involved in helping to seed, Pantera, he came and said, Dan came and said, I'm shutting down my macro fund. I'm going to get involved in this thing called blockchain and Bitcoin. And we're all like, seriously, why? And it's first of my many bad decisions. If you're going to be a gold miner, you have a choice. You can go try to mine gold and someone with a bigger gun can jump your claim, or you can try to be Levi Strauss and sell blue jeans, and you get rich by picks and shovels. We chose picks and shovels. In hindsight, I should have put the money in the Bitcoin fund. We're doing great in the venture vehicle, but I started spending about 1% of my time thinking about blockchain, crypto. A couple years go past, they're raising a new fund. We start to meet some of the other players. We put a little more capital in, have a little bit of experience in some of the early discussions about ICOs. Now I'm up to about 3-4% of my time. And about a year and a half ago, I started tweeting about, actually, back up, I started writing about blockchain and particularly Bitcoin in first quarter 2014. And I had clients basically say they're going to fire me because why are you talking about that stupid stuff? Get back to traditional investments. That's when I knew it was a good idea. It's like on Twitter. If people hate you on Twitter, you're onto something. If people love you on Twitter, just stop doing that because It's a perfect contrarian indicator. So started tweeting about crypto and blockchain, saying it was going to be big, really big, and just got eviscerated. I mean, people said, you're an idiot. And that's when I really started thinking I was on something. And I actually ran into Pomp on Twitter, and I just started liking everything that he said. I'm like, wow, this is like...
I appreciate that engagement, by the way.
Yeah, and it was one of these things where I just said that, I think that. And so I said, we have to meet, and we met. And I like to say that I know in 5 minutes if I'll never work with somebody. It may take me 5 years to decide to work with other people, but I knew in 5 minutes that we had to get together, and it didn't take long from there for us to combine forces.
Great, so you combined forces, announced recently that you're planning on raising a $500 million fund that invests in security tokens. Your background, Mark, really is coming from the endowment world.
Yep.
And I think when you came from the endowment world into private practice, if you will, and started your own fund, you kept a lot of the same characteristics that were in an endowment model, which is a heavy allocation to real assets.
Yep.
And what we saw, let's call it from the 90s or maybe the 80s on, were endowments that had these large allocations in real assets outperformed other managers significantly. Yeah. Is that part of your decision to go into security tokens?
Oh, look, this is really simple. If you look over the last 20 years, the best performing fund is not Yale. Everyone thinks Yale's number one. They're actually number three. The reason they're number three is they have 58% in private assets, real estate, private energy, private debt, venture capital. The second best performing fund actually is 40% venture capital, 40% hedge funds, 20% emerging market equities, and the best performing fund is 15% in cash, 85% in private investments. And the illiquidity premium is what drives great returns. And the illiquidity premium is captured in real assets, in property, in things that you can that you can touch and feel. So we've always invested with this endowment model, and 15 years ago when we launched, all the bad guys were in private equity and venture capital and hedge funds. First time I went to my board at Notre Dame back in the late 90s and said we're going to invest in hedge funds, they're like, no, we're not. That's where all the bad guys are. That's where all the criminals are. So you basically want to go where everyone thinks all the criminals are, and that's where the best investment opportunities are going to be. And I'm serious, because that's who adopts technology first, is the fringes. And then it becomes internalized and moderated. So again, met Anthony, and he convinced me very quickly that crypto is interesting and great, and I'm big Bitcoin maximalist. I think it's like Saudi Arabia. Bitcoin is king crypto, Ethereum is the crown prince, and there's a whole bunch of princes that hate each other. Most of them are going away. Then you've got utility tokens. It's just early stage venture capital. 90% of those are going away. 10% are going to be unbelievably huge, but you need someone who understands tech, someone like Anthony who came from Facebook and other places to understand tech. But he convinced me quickly that security tokens was where it was all about, because our world is all about getting institutions to invest in hard assets and tokenizing hard assets. And I won't steal Anthony's thunder. I'll let him explain how that works.
Sure. So, Anthony, as you think about this $500 million fund that you're talking about raising, how do you think about investing that money? Where are you thinking about investing? How are you thinking about deploying it?
So I think, forget the fund for a second. There's a couple of things that we believe that other people don't. And so part of investing, you've got to do something that is different, and you've got to be right, and that's where the outsized returns are. If you do something that's different and you're wrong, you're just an idiot, right? If you do something different and you're right, that's where all the upside is. And so everyone right now is investing in hot air, right? If you look at the utility token market, if you look at most of the cryptocurrencies, it is complete garbage, right? And the reason that it is complete garbage is because these people have lost their minds and they're chasing 10,000% returns. It's greed, right? And so if you ask somebody, why did you invest in that? Most people can't even bring themselves to say, I'm doing it because I think it's going to go up in value. It makes zero sense. So if you think of a new piece of technology that can be applied to build new things, or a new piece of technology that can improve the old world, everyone is in this new world stage, right? Mark's previously said, it's just early stage venture, and so everything should go, like 90% of it should go to zero, right? Because it's all these new things that people are trying and experimenting and all stuff that's going to go to zero. Well, Here's the problem is most people don't invest in venture capital because they don't have the financial means to do that. With these utility tokens, which are unregistered securities, the SEC has very clearly laid that out, that we are now allowing people to invest in this stuff and they don't understand the risk reward profiles. And so you're taking a highly sophisticated asset class that people or professional managers have exposure to, and we're not letting anyone invest in it. Well, that's all great. That's going to blow up and it's not going to be very sustainable. You know, newsflash everyone in the room, anything that 10x's in a year, not sustainable, right? Like, not sustainable at all. Now, go to the other world. Here are hard assets. And so there's this quote, Howard Marks of Oak Street Capital says, if you want to be in the top 5% of returns annually, you have to take such inordinate amount of risk that when you're wrong, you end up in the bottom 5. So if you want to be in the top 5, you got to be willing to be in the bottom 5, right? We don't want to be in the top 5 or the bottom 5. What we want to be is above average consistently over a 20 or 30 year period with a hard asset that I understand the floor of the investment. So take this building, for example. If I buy this building in the private illiquid market, right? If none of the tokenization stuff works, I'm not going to zero. I could be completely wrong in my thesis. I'm not going to zero. I still own the building, right? There's a hard asset that has the floor of the investment. If somebody goes and they buy a utility token and they're completely wrong in their thesis, it goes to zero, right? We don't think Bitcoin is going to zero, but Bitcoin can still go to zero, right? And so it's all about risk return. Now, utility tokens, cryptocurrencies, it's like the venture world, right? So a lot of people in tech think that venture capital is a really big deal. Well, in venture capital, you actually put a very small amount of money to work and you're looking for those outsized returns. And so if a venture capitalist raises $1 billion fund, like front page headline of every tech publication for a week, right? In the private banking or traditional banking world, that's one deal at one bank on one day, and maybe somebody writes about it. Like, it's not even a big deal, right? And so what you end up having is you have high risk, high reward versus low risk, lower reward, but higher probability of not going to zero. Well, when you're talking to institutions, guess which pile they like? They like low risk, low reward because they're putting big dollars to work. So today, utility token market sub 400 billion. Right? I think the security token market is going to be trillions of dollars in the next 24 months, right? I think the SEC is going to mandate the technology either through a direct decree or they're going to do it through forcing people to adopt the technology. And then on top of that, we think that the institutions don't really think that other stuff's that interesting. They don't understand the asset. They understand real estate. They understand equity in companies. And so this institutional capital that's coming is not coming to save the utility token market. It's going to go right into the security token market because it's what they understand.
Sure. Can I jump on that for a second?
Yeah, sure.
I mean, what's really compelling about this is the conundrum that large asset owners have today, which is if you look over the last decade, the average pension fund in this country has made about 4 to 5% return. There's a technical term for that. That sucks. And I was out at a pension fund out in California, and I won't name names, but I was out at their meeting, and they announced that their returns were actually less than that. They were 3.5% for the last decade. And the actuary came in and said, all right, I have a solution. We're going to lower our actuary assumed rate from 7.5 to 7. And I raised my hand, and I said, 3.5 is still less than 7. And they said, oh, I can't believe you say that. That's so offensive. I'm like, no, it's just math. And I said, the only asset over the last 10 years that has beaten your actuary assumed rate is private investments. So private equity, private real estate, private energy, private debt. That made 11. And I said, again, very flippantly, 11 is better than 7. And again, the consultant went ape shit and was very unhappy with me. And I said, but what, and you have 1%. So they need to go from not having 1% to having a huge percentage. And that wave of capital, the great wall of money, it's coming. And here's the problem, though, is even the private investments. What's the cap rate on trophy real estate in New York City? 4? 3.5? 3? Stupid, right? You can't make a good return at a 3 cap, right? It's not going to 2. It's probably going back to 5, and then you're actually going to have a problem. So what the beauty of security tokenization is, or what we like to call digital securities, DSOs, digital securities offerings, what the beauty of that is we can take assets that are real, have cash flows, have inherent value, and we can capture the illiquidity discount for the owners of huge volumes of assets that have to pay liabilities in the future. This is nirvana right? If I can take a 6-7% asset or a 3-4% asset and I can turn it into a 7 to 11% asset, that is manna from heaven. I don't need to make 10x, I don't need to make 20x. I just have to add 400 or 500 basis points of illiquidity premium. Think about it. How many buyers in the world are there for the Plaza Hotel? 500, 600, not a huge number. If we could fractional ownership tokenize that asset and sell it globally, 24/7, how many owners? 500 million? A billion? I don't know. It's a big number. So that capturing of that illiquidity premium or illiquidity discount is a monster opportunity, the biggest opportunity of my lifetime. And I'm going to spend my entire chapter 3, right? Chapter 1, I work for not-for-profits. Chapter 2, we built a traditional firm. Chapter 3 is all about security tokens.
Sure. So you talked a little bit about Anthony, utility tokens before, and retail investors drove that entire market. And what I'm hearing you say now is, listen, institutional investors are going to love security tokens. What are you seeing today? And I guess this is for both Mark and Anthony. What do you see today as an appetite for security tokens?
So there's no such thing as a security token, right? We're buying assets. So I see all these people taking notes. Write this down. The big banks are asleep, and we're about to go on an epic run because they can't even hold the shares. Go ask any of the banks. They don't even know how to hold. If I tokenize a piece of real estate today, they don't even know how to hold that equity. They are completely flat-footed. But it has nothing to do with a security token. First of all, we call it a token. It's a share, right? It's digital, which happens to be a security. We can call it whatever we want. 3, 4, 5 years from now, we're just going to call it equity, right? How many people in here have bought a public equity in the last 5 years? All right. How many of you turned to your friend after you did it and said, I bought an electronic Apple share on the DTC? None of you. 0. Most of you don't even know what the DTC is probably, right? Which is okay because you signed into your brokerage account, you bought a share, and you own equity. That's what you wanted to do. Same thing here. This whole thing of like all the hype around like blockchain and security tokens, all stuff, all that's going to happen 3 years from now is somebody's going to go into their digital wallet, which is a new brokerage account, and they're going to buy assets, and they're going to have no clue about anything any of us in here are talking about. 0 clue.
And they won't care.
Yeah, because they just bought the building or they bought shares in the company, whatever.
Is there friction today, though? Is there friction when you're going to institutions explaining, okay, this is the new ownership structure?
Right? Oh, there's massive friction. And look, the reason that we're going to go down this path of digital securities and raising a fund, a digital securities fund, that's going to be the name of it probably, is that we're trying to get people away from this fear of crypto, right? They're all freaked out about crypto because they think it can all go to zero and they don't really understand it. And it's the crypto kids, right? It's the big beards and the flat brim hats, and they're scary, right? For the traditional institutions, they're just scary. Now, there's another piece of that, which is, and Anthony wrote a piece about this or tweeted about it. Think about it. Just because someone got lucky, now there was some intelligence too, but most people just got lucky, right? They bought a lottery ticket in 2009, it went up 1,000 times. Do we really think that person should be a money manager? Right? There are 220 crypto funds now. 85% of them have less than $20 million. And that's just somebody's lottery ticket that now they want to be an asset manager.
Well, and I'll go off this. So a lot of people always ask me, why did we do this deal, right? And why am I sitting up here next to them? It's because we were one of those people. I couldn't walk into an institution and say, give me $100 million. They literally would, I don't even get in the room, let alone raise the capital. Now when we walk in the room, oh, by the way, Morgan Creek, financial institution, compliance, all the risk controls, manage billions of dollars. But you just go down the line, it's a completely different profile of somebody raising capital from an institution than the 2-3 person hedge fund that walks in and says, hey, give me money and I'm going to go buy this asset that you literally don't even understand.
Yeah, and flipping that on its head, we as Morgan Creek couldn't just raise our hand and say, wow, I see this, so now we're going to do it. So I had to go find some talent. And again, follow the talent, follow the money. The talent is migrating. Some of the best talent, some of the smartest people I know, like seriously smartest people I've ever met in my career, have left good jobs, real high-paying jobs, and are coming into this space. There's a reason for that. That's amazing and cool. The second thing is the money isn't flowing yet because it's still afraid. right? It hears, oh, the SEC is going to go after ICOs. Well, they don't know what an ICO really is, and they haven't internalized that that's venture capital. All of us do venture capital. You'd never do one venture capital deal. That would be stupid, right? Doing a portfolio of venture capital deals where 90% go to zero and one goes 10x or 20x, that's a really good strategy. And long term, that's why Jeremy Grantham's asset allocation is 40% venture, and he's the second best performing fund in the country. So, but what's really amazing is you go talk, I went to give a speech to a pension fund up in Michigan, and I spent an hour with their board. The last 5 minutes, we're talking about cryptocurrencies, utility tokens, security tokens, last 5 minutes. They said, hey, can you stick around and talk for some more? An hour later, okay, so now I spent an hour and 5 minutes on crypto-related stuff and 55 minutes on traditional stuff. They didn't want to let me go, and they wanted to talk about this, and we got to get here, but we want to put infrastructure. Like, well, yeah, we can help you with that, right? Mining is infrastructure. That is an infrastructure investment with a high cash-on-cash return. We can help you do that. There's asset back. We can help you with fund managers who aren't crypto kids, who are actually, met a guy at Consensus. This guy has 20-year track record, 29% doing stat arb. Okay, someone showed him to do, and last year was a crappy year for stat arb and traditional because there was no volatility. He started trying his model on crypto. I said, what are the returns? He said, they're obscene. I said, like, how obscene? He said, I can't tell you because I don't think I can replicate it, but I think I can beat my 29% over the last 20 years. Easy. That's interesting to an institution. So there's ways to get them to take this great wall of money, again, measured in trillions with a T. And we throw around this T word so much. I'm like, no one shudders when I use the T word. I'm going to lock the doors, make you sit here with us for the next 31,710 years, which I promise will be most unpleasant. You got to spend $1 a second. That's $1 trillion. $1 a second for 31,000 years. So $1 trillion, to say $10 trillion going to come into securities, is digital securities, is amazing. And all this is, at the end of the day, is we're using 400-year-old technology, paper, and we're going to today's technology of digital, true digital ownership. And there do not need to be there are 9 different accounts that have to balance and check a traditional securities transaction. That's why it takes 2 days to settle. And that's why it takes 6 weeks for other types of securities to settle, and 9 months in some cases for a bank loan to settle. Ridiculous.
You want to hear my new thing for 2018? How many people in here think that the crypto hedge funds, on average, are going to outperform traditional hedge funds this year? Yeah, that's like less than 5% of the room just raised their hand. Last year, the crypto hedge funds, on average, the average was 700% return. Most of them got started halfway through the year. 700% return. I think traditional was like mid-teens, or 10. Okay, so 10, right? 700 to 10. Everyone's like, oh, that compression is going to take a really long time. I always laugh when I hear that people lost money on Bitcoin last year. Like, there are people in the world who, an asset at 15x, they lost money, right? They're just not sophisticated, they don't have strategy, all stuff. Well, this year, when there's a 60 to 80% drawdown in assets in the first quarter, how many of you think that the crypto hedge funds are going to outperform the traditional hedge funds? Maybe. Sure, not going to be 700 to 10% comparison. And so we already may see that highly volatile, top 5, bottom 5% be playing out. And if that's the case, the institutions are never going to touch that world except for the highly sophisticated guys that have track records, they've got teams, that they can prove that these strategies work regardless of the asset.
Right.
Yeah.
Right.
There's one other really important point. I know we're over time, but a really important point.
We can just stay up here for 31,000 years.
Yeah, 31,710 years. And we'll give you $1 every second to stay with us. So the key is that pension fund that I met with, their minimum check is $150 million. There is zero chance, that that's going to a crypto kid. Zero, okay? There's a 5-10% chance that they might give it to somebody playing in ICOs. They might. Probably not the whole 150. They might spread it out over a couple. They might. There's a 90+% chance, don't know the timing, but there's a 90+% chance that they're going to write that check to infrastructure, to real assets, to private investments. And look, trading Apple shares over a digital security, not interesting to them. They'll end up doing it because everybody will. But what's really interesting to them is being able to own assets that they understand. And Anthony describes it really well, saying, we can tell you your downside. And if we can add the upside of this capturing the illiquidity discount, then they get excited because they're faced with, from this point today, an owner of assets is faced with this lovely conundrum. Bonds over the next 10 years will make 3%. There's no debating it, there's no arguing it. The 10-year return on bonds is the yield on the day you buy the bonds. That's how bonds work, okay? So 3%. Equities, depending on who you listen to, Jeremy Grantham, Cliff Asness, AQR, Rob Arnott, all these guys are between -4 and 0 for the next decade from here at these valuations. And you can pretend that valuations are going to stay high forever and that the PE is never going to come down. That's fine, you can pretend, but over the next 10 years, smart people are saying -4 to 0. Let's be nice and say you get 2 points from yield, 2 points from inflation, 1 point from real earnings growth, and you only get minor multiple compression, so you get 3. 3 from stocks, 3 from bonds. Mix it up any freaking way you want. 90-10, 10-90, 80-20, 60-40, even 100-100. Lever up 100%. You're still less than 7. So they've got to do something different, and that different is buying these assets in a structure that allows them to capture this illiquidity discount. And I said, I got the epiphany.
They're going to tokenize the world.
They're going to tokenize the world, brother.
That's what they're going to do. They're going to tokenize the world.
Let's do it.
Mark, Anthony, thank you very much.
All right. Oh, I didn't know they were going to stop us.